Welcome. We are live on LinkedIn, we're live on YouTube, and we're live in person. How's it going, Doug?
Doing well. It's the first day of school, Kirk. So in some ways, other than the scramble to get my kid to school and get all that stuff, it's a lot better for me than it is for my kids. Now starts the period in which we can actually work a full schedule without that intraday glorified taxi service that somehow summer camps and summer programs all think that parents have the ability to do. Like, we're going to start this camp at 9:30, we're going to end at 11:30, turn back around at 1:45, drop off at 3:30. It's like, these people that run these work, right? Do they understand that the rest of us do too? So it's glorified. It's time where I get nice full day of focus, and my kid can deal with the drama of school. We'll deal with that after school.
Doug hasn't had his coffee yet.
Are you kidding me? I'm on 3. It's pumpkin spice latte season's back. I tried one for the year, and then I'll go back to black every day.
Nice. All right, well, let's get started. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name's Kirk Chisholm. I'll be your host today. I'm joined with my good friend Doug Hagerin. How's it going, Doug?
I'm very good, Kirk. I don't think anybody needs to hear me explain it all over again. Life's good.
That's good. Good. Well, as you might notice, I'm feeling a little green today. My virtual background decided to stop working for no apparent reason, and it's the sign that we still have a week. So but Doug's kids went back to school today. We still have a week. Our kids go back next week, and I think it's a sign of things just breaking right before the rush and good times. So,
I just want you to know, Kirk, that I'm just happy it's your tech, not mine.
I wouldn't say it's a first, but it's one of only a few. So we'll be thankful for that. Those of you watching, enjoy my green background. I'll try to maybe put something fun up there later on the recording. So, all right, well, let's dig in. So I was on vacation last week, and thankful for it. It's like one of the only weeks of the year I actually get to go on vacation with the family. So that was a lot of fun, and got to disconnect a little bit. And you know what happened during that week, Doug? Nothing.
Well, I heard that a bunch of people having something to do with banking had vacation in Jackson Hole, Wyoming. Not sure that where I love that they talked. I saw an article, actually. It was really funny, Kirk, where they were talking about weren't invited to the Jackson Hole party. It was like, nobody's invited to the Jackson Hole party. This is like going to the Oscars, where a bunch of people that have no connection to the rest of us get to rub each other's shoulders. Or wait, maybe that came out wrong. They get to pat each other on the back and tell each other how much they love each other and make more money for the 1% of America.
Yeah, I don't really know what happens over there in Jackson Hole, but it ends up a lot of hobnobbing, palm pressing, a lot of, hey, you did great this year. Oh, you did great this year. You did great this year. A lot of that goes on over there.
What was your bonus? That's my house over there. We just bought this year.
I bought a bigger yacht than you this year. How long is your yacht? Like what do they possibly talk about there? I don't know. Anyway, yeah.
It's like being a Tahoe, Kirk, and you know what that's like.
Yeah, basically, Powell came out and made a statement, and it amounted to a whole lot of nothing. Oh, yeah, I'm going to continue along the same path. Oh, really? Oh, that was a shocker to everybody. We had no idea you were going to do that. So, I think at the end of the day, what it comes down to is, you look at Powell, and he's trying to direct the markets. And, I think what's funny is most people have absolutely no idea of what is going on in the markets. And you know what? Powell's telling you what's going to go on, and no one believes him. They're like, oh, where's the market going to go? I don't know. Let's follow Powell. What's he going to say? Oh, really? Interest rates are going to be higher for longer? Oh, well, let's assume that rates are going to go down next month. I mean, I get it. Believe me, I don't trust the Fed at all. I don't buy what they're selling ever, but he's been pretty clear about what he wants. And when you talk about 2 years ago, or was it 2 years ago? Yeah. Well, 2 years ago, 2021, when he said, hey, we're going to start raising interest rates, and everybody's like, no, you're not. No, you're not. We're going to just, we're going to go about our business. And then January, everyone starts selling bonds. We're like, oh my God, he's going to raise interest rates. People tend to just not believe him. And I get it, because a lot of what the Fed does is they are a PR machine. That is their best weapon against inflation, the markets, anything they want. It's a PR machine. they can claim to do something and the market will react. So, like, to take 2020, for example, during COVID, everyone was afraid of the high yield bond market meltdown, which everyone knows is there, everyone, including the Fed. So, the Fed knows about it, means everybody knows about it. So, the Fed knows that the high yield bond market is basically on a precipice and is, I mean, the littlest thing could implode it. And I'll explain this really briefly and we'll move on because it's not an issue today. So I don't want people freaking out. But basically, the issue is over the last 15 years, the bond market, which is segmented into different ratings, anywhere from AAA, which is the highest, to C or D, basically default. But it basically you have AAA, AA, single A, then triple B. That constitutes investment grade bonds. Investment grade means that effectively, hey, there's nothing to see here, everything's fine. Okay, that's what a lot of institutions say. Hey, we can only invest in AAA. I'm sorry, we can only invest in investment grade. So a lot of like nonprofits or what have you, they don't invest in junk because it's risky. Anyway, the point being is it's considered safer than junk bonds, which is double B, single B, C. And so what's happened over the last, I don't know, 10 years, especially the last 10 years or so, is a lot of debt has been downgraded to triple B. So there's a huge amount of triple B paper sitting out there, and it's not quite junk, but it's borderline junk. And the amount of companies and the amount of debt that is triple B has been increasing quite a bit. And so the fear is that we go into a massive recession and everything gets downgraded, right? Rely on the rating agencies because they're real sharp. I just watched The Big Short last week and it was glorious. I love that movie so much. Where the ratings agencies basically, they just, like, hey, we're getting paid. They don't pay us, they'll pay somebody else. So we gotta, sing the tune. So anyway, if you haven't seen it, great movie.
It's right up there with Shawshank. You have to rewatch it every once in a while.
Absolutely. Absolutely. Another great film. So if you think about it, like you've got all this triple B paper. Now, let's say we go into a deep recession, everything gets downgraded. What's going to happen? Well, portfolio managers that only invest in investment grade have to sell because it's no longer investment grade. And then junk bonds or junk bond portfolio managers have to buy, right? But the investment grade market is enormous. The junk bond market is tiny in comparison. So you basically have a fire hose going through a straw, right? It's not going to happen, right? So what's going to happen is no one's going to be able to. So if you think about it this way, let's say you have $1 billion trying to go into $100 million allotment. Well, effectively, what's going to happen is people aren't going to be able to buy the $900 million of bonds. So if they can't buy it, what happens? Well, the price drops until it gets to a point where somebody will buy it. So what happens is basically an implosion of the companies that get downgraded if too many happen at the same time, right? So you think about 2008, a bunch of banks went under at the same time. Well, what happened? Well, the FDIC, it's their job to take over the banks, but they can't take over them all at the same time because their budget is really small. So they went through, over years, they went through a few here, a few there. But basically, you had these zombie banks just sitting around waiting to get taken over. So what happened? They didn't foreclose on loans and on houses, and they didn't file for bankruptcy. They didn't push loans into default. They did all this stuff just to keep afloat, right? And it allowed home buyers some grace in many ways because people were living in their homes. They weren't paying on them for years, and they were just living in these palatial homes and not paying mortgage rates. So anyway, getting back to the point, this is a big problem. Everyone knows it's a big problem. So what happens in 2020? Well, what happened is the Fed came out and said, we're going to buy all high yield bond paper. So what happened? Well, high yield bond paper didn't decline as it should have. It just said, hey, great, they're going to buy it. So everyone went in and bought high yield bond paper. How much high yield bond paper did the Fed actually buy, Doug? That's right, goose egg. They bought none.
Zero. Sorry about that. I was on mute. Yes,
that's
none.
Okay. They bought zero. Why? They didn't need to buy it because the market believed them. The market believed they were going to buy it. So the market got ahead of it and said, we're going to buy it because the Fed's going to buy it from us. Well, the Fed didn't buy it, but it didn't matter because they did their work. They did their work to support the high yield bond market so it didn't implode and didn't have all these bankruptcies everyone knows is going to happen. So it was a great tool, and they did absolutely nothing other than talk about it. That is one of their greatest tools. And I love that example because, there are many examples, but that's just the most obvious one because it's such a huge problem. So the Fed does a lot of things under the radar, and people in Wall Street know this, but the retail public doesn't because they don't see this sort of thing. So it's really important to keep that in mind that their biggest tool is the mouthpiece. So when they're talking, they're trying to make something happen. And this is what I want to get across. When the Fed is telling you something, they're trying to get an outcome. If you don't believe that outcome, they're going to keep trying until they get the outcome they want. Now, right now, inflation is 3.2. It's a lot lower than it was at 9. And sure, the PCE is definitely higher, and it's they're uncomfortable with the PCE, which is typically their measure that they look at for inflation. It's not necessarily the CPI; that's more of a retail measure. They use the PCE, so it's still a little bit high, and they don't really like that. So Powell's sentiment is we're going to keep pushing on this. And what's really important to keep in mind is Powell wants to be Volcker and not Burns. Now, what happened in the 70s, in the early 80s, is inflation in the 70s, inflation was high. Then the Fed raised rates and inflation went down. And then the Fed dropped rates and then inflation spiked up. And it ended up going up to, I don't know what the Fed funds rate went up to, like 18, 20%. I forget what it is offhand. But anyway, went really high.
I can tell you I was seeing tax returns where people were getting almost $100,000 in interest because the interest rates were close to 18 to 20%. Absolutely.
Yeah, you're getting 30-year treasuries at 15. You're getting mortgage rates at 20. I think it was like 18, I think is where the Fed funds rate went to. But anyway, the point being is they went a lot higher than they are today. And they did that because they wanted to squash inflation. And they did. And they squashed the inflation. They squashed the economy. They squashed a lot with interest rates that high. But they went back and they said, if I had to do it again, and I think they were talking to, I forget if it was Volcker or Burns, but they were talking to one of the Fed chairs, and they said, if I had to do it again, I would have kept rates lower for a lot longer than we did to squash inflation. We never would have let that second spike happen. So Powell knows this. Everyone else knows this. They're going to keep rates higher for a while to make sure inflation is squashed. And until they do that, you can expect rates are going to be high. Now, it doesn't mean they're going to keep raising. It doesn't mean they're going to keep climbing. It doesn't mean we're going to have 10% because they're said, hey, we're going to have high interest rates. We're at a range right around 25 to 50 basis points. 5.25 to 5.5. Approximately that range is where we head for our market. We had 5 to 5.5% for our market. We've saying this in the show for the last 2 years. That's the rate that they're gonna focus on, and it's going to remain there for a while. And I think it's going to remain there. Probably the market thinks for the next year. I mean, we're going to show a chart here later, I think, which talks about that. But the market is predicting that by the end of next year, the rates are going to be, I think, a few percentage points lower. Well, in order for that to happen, we have to be in a recession. It's not because at this point, they're not going to drop rates where we are. The economy's fine. And inflation is still higher than it would normally be prior to 2020. So they can still keep it there. It's not affecting anything. It is, but it's not affecting anything on the surface. So there's no reason for them to drop it here. If they start dropping it, the market's going to shoot up. It's going to go through the roof. They don't want that. The market's already extremely expensive. In some metrics, it's more expensive than it was in 1999. Some metrics it's not, but more or less, we're really expensive in the market. So do they want it to go even more expensive? Probably not. That would be really irresponsible of them. So realistically, we need to see, I don't want to say a recession because who knows, if it's a recession or not. Well, now they have the Ministry of Truth in the government. But realistically, we have to expect the fact that we are going to see a lot of managing of the direction of the economy from here. We should not expect the markets to just skyrocket from here. I think we're going to see a lot of messy middle, as we call it. And I think that's just what we have to get accustomed to. So, Doug, what are your thoughts?
Well, so I don't know if you ever watched Saturday Night Live when you were younger.
Yeah. Love that show.
One of the best, if you want to go out and have a great laugh, go out and rent or watch or stream, I guess these days, the best of Saturday Night Live, best of Eddie Murphy.
Love that one.
If you've never seen his skit, Mr. Robinson's Neighborhood, a take on, obviously Mr. Rogers, okay? But he used to say, that brings me to the word of the day, boys and girls. And if you would like to look what I just uploaded to you there, Kirk, and put up the word of the day, you're going to get to see it here in a second. Going to be the last things I posted right there for you. Yep. Kirk's going to bring this up here really quickly. Word of the day, folks, boys and girls, is deja vu. If you haven't heard this, we've been saying this for how long? People have been saying it. We've said it over and over again. Powell is telling you exactly the same message over and over and over. And here's the definition of deja vu: a feeling of having already experienced a present situation, or a tedious familiarity. Just like looking in the mirror that reflects off into perpetuity. So listen, this is what we're facing right now. The other thing that we're facing right now is, and I think it's really important, is, as you said, rates may not go up any higher, but I also want to take everybody to pause and listen. That sound you hear is the vacuum of money being sucked out of the system. The problem with that is there was so much money in the system. Right now, prime rates are currently right around 8.5%. I want to tell you where this affects a lot of people. Okay, a lot of people out there have 401k loans. 401k loans are generally around prime +2, which means in just a matter of about 12 to 14 months, the loans that people had on their 401ks that they have to pay back roughly, usually around, a 5-year maximum, unless they did it for a house, just went from maybe about 5-6% to 10.5% minimum. Okay. That is a significant increase in cash flow requirement in order to just repay those loans. There's billions, trillions of dollars out there in 401k loans. And that's not just those loans. We're starting to see, and again, not tied directly, starting to see mortgage rates kick back up again. We've already talked ad nauseum, deja vu, deja vu all over again, as Yogi Berra used to say. We've talked about how, this is going to be, we're going to start to see an increasing amount of pressure. We've already started to see it. We've got some other charts that we might get into today that talk about it. We're starting to see that trend shift where people are starting to struggle a little bit. And whether if you've got credit card debt, or if you're trying to buy on a house, or hey, listen, Kirk, I've run into people again who've got variable rate, ARMs on mortgages they took over the last couple of years. That's about to kick up. Student loans are about to come back in as well. And all of a sudden, the American cash flow is going to start to feel the pressure that Powell has hoped, just so you know, hoped, as those guys patted each other on the back with their nice multi-million-dollar homes in Jackson Hole. They are hoping that the average American has the cash sucked out of their checking bank accounts. And we got some charts on that too. But the other thing, I posted the maturity structure of U.S. Treasury securities in millions. Horizon Kinetics put this out there. We are looking that in the next couple of years, okay, over half the U.S. federal debt, closer to 16 trillion now to 31 trillion, will mature in the next 2.5 years. That means higher rate debt is going to now have to replace low rate debt, or inflation runs. That's their opinion. Okay. So there are some opinions on this, but if you start to look at the data there's going to be a lot of rolling over. The U.S. government just got downgraded. Okay. So they got higher debt coming out, higher debt service themselves. They got downgraded, which puts pressure on the U.S. debt. I mean, again, I'm going to go back to it. Deja vu all over again. The same thing we've been saying. There is one end game here, and that is to counteract runaway inflation by absolutely throwing in the things that create deflation in a way to check that. And that is going to be sucking money out of the system and making it harder to get money in the way that we've seen over the last 20 years.
Yeah, no, what you talk about, Doug, here about the sucking of the liquidity from the system is really important, and this is something people don't realize. So if you look at, and I don't have one of these charts offhand, we'll try to find one. But if you look at a chart that shows the S&P 500 overlaid on the money basically created in the system, what you'll see is a correlation, not a causation. We don't causation's a different road. A very high correlation of the S&P 500 to the amount of money printed in the system. Very high correlation. Now, what you're seeing now is actually one of the few times in history where they're actually sucking money out of the system because there's too much in the system. So they're trying to suck it out and they're reducing the amount of liquidity in the system, which means that if we get into a precarious position, let's say I think it was March of this year where Silicon Valley Bank and Signature Bank and a few other banks went under, that was actually a low point in the liquidity cycle. And, you could argue why that happened. There are many reasons why it happened, but the liquidity cycle actually inverted at that point because we were sucking it out of the system. And then all of a sudden we bailed out these banks, huge spike in liquidity because you don't want the whole banking system to implode. Huge spike in liquidity, right? And all of a sudden the market bounced back. And then now you're sucking it out of sucking the liquidity out of the system again. So what it's going to do is it's going to cause some hiccups. Really, it's going to cause some challenges to the system because ultimately, if we have less liquidity, you just have you have fewer dollars chasing the same stuff, and what that effectively leads to is a decline in asset prices. So I want to actually show this here because this is what I was talking about before in the last part where I was talking. This is the discount rate current expectations. So remember when I was talking about before about here are the Fed expectations. Now, of course, this was a few weeks ago, but what this shows is each month what the discount rate and the current expectations are for the market. So what this means is here is the current rate, the end of August, and they expect maybe in November that it'll go up a little bit, and then as of next year, it's going to start to decline. And it's going to decline a full 1% by the end of next year. Well, what that means, if you're going to decline 1%, it means that either A, inflation has got horribly low, which I think is probably unlikely, or we go into recession. Now, recession means it's going to go down faster. And certainly, depending on what happens, the Fed will try to support it and keep us from going into a deep recession because they've got a big margin of error right now that they could drop it 5% and they could do a lot to cause us to get out of the recession. But the point is they're trying to push us into a slowdown because they need to. I mean, we're overheated in many ways. There's metrics that show on one hand, hey, everything's doing great, and on the other hand, they're doing terrible. So it's really kind of this kind of market where it's a messy middle, as I call it, where the direction is not clear. But what is clear is the market thinks that the Fed is going to drop rates by the end of next year. Now, does that mean that you should sell all your stocks and run for the hills and put all your money in gold and live in a cave? No. What it means is the market could very well be wrong. Now, the market's not typically wrong. The market is the market and the price is the price. And you have to honor the price. However, this is an example of what we've been talking about is the market doesn't believe the Fed. The Fed says we're going to be higher for longer. I think that they're going to stay at this rate somewhere between 5.5% for a few years. And by a few years, I mean until we have a pretty significant recession and the certain metrics that the Fed looks at change dramatically. And right now, I just don't see that happening. It's not lined up, which means that we're going to be here for a while. And we're going to talk about either next week or later today about what that means for you and why it's such a benefit. Now, most people think that, well, high rates is going to be a problem for the market. Yeah, well, you can get high rates. When's the last time you saw 5% U.S. Treasuries, Doug? Maybe like 20 years ago? I mean,
I mean, people are actually excited to have cash for the moment, even though, comparing that to the cost of everything, it's all relative. But I mean, the last time I actually saw people excited to have their money earning interest has been, I think I was coming out of college.
So I want to read a quote here from Howard Marks. And if those of you who don't know who Howard Marks is, you should read his newsletter. This is actually one of the newsletters that Warren Buffett reads. He says he will not miss a newsletter issue of Howard Marks. That's how smart this guy is, that Buffett actually reads his stuff. Okay, so just to give you some context, because he's not a household name like Buffett is. He doesn't have the PR that Buffett has. So here's a quote. We've gone from a low return world of 2009 to 2021 to a full return world, and it may become more so in the near term. Investors can now potentially get solid returns from credit instruments, meaning bonds or fixed income, meaning they no longer have to rely as heavily on riskier investments to achieve their overall return targets. Lenders and bargain hunters face a much better prospect in this changed environment than they did 2009 to 2021. And importantly, if you grant that this environment is and may continue to be very different from what it was over the last 13 years and most of the last 40 years, it should follow that investment strategies that worked over the periods may not be the ones that outperform in the years ahead. So I want to highlight this one thing that he also said a little bit later. So be careful. Whatever made you the easiest money during the last decade could be your worst idea today. Now, this is one of the smartest guys in the room. This is a guy that every smart investor reads because he's got some great insights. This is one of those insights. And this was, I think he wrote this like the beginning of the year. I forget when he actually wrote it. It was the end of last year, beginning of this year. This is what we've been talking about for like the last 2 years, is that high rates are a good thing for many investors. If you can get a 5.5% US Treasury, which is, I hate using the word guaranteed because we're not allowed to use it, but I'm going to throw it in here with context. The risk-free rate is as close to guaranteed as you can get. And this getting a 2-year US Treasury is not risk-free rate. If you're getting like a 30-day, if you're getting a short-term Treasury, it's closer to risk-free rate. The point is we're really close to that risk-free rate, right? Between 0 and 2 years. And that's where the real money is made, is 5% and up, is in that period. If you're getting 5% from the US government, which is, even though they got downgraded, they're still one of the best credit risks out there. You just are. You're getting really low risk 5% rate compared to a stock market which is as close to all-time highs as we've been in the last year and a half. We're not at the all-time highs, but we're maybe 7-8% off that, and you're getting 5% with virtually no risk. If you assuming you can hold to maturity, why wouldn't you consider that? And what he's saying is that effectively the easiest money was made in the last decade from equities, from big tech, the Magnificent Seven or FANG or whatever they're calling them now, right? They always come up with some moniker so they can sell you more stuff. The easiest money was made in tech, was made in the NASDAQ, was made in stocks. That was the easiest money. US stocks, I want to be clear, not everywhere. That was the easiest money in the last decade. That could be your worst idea today. That's what he's saying. In a low interest rate world, easy money is, let's go stocks, let's go tech, let's go all in on the Magnificent Seven. That's what everybody did for the last 10 plus years. And they made lots of money. Was it prudent? Not necessarily, but that's what happened. What happened to value stocks? They underperformed. Does that mean that they were bad investments? Absolutely not. It just means they underperformed in an environment where we had low interest rates. Now we have high interest rates. Value stocks should tend to do better. Not all of them, but some of them should tend to do better. Financials are value stocks. They should do better, except for the fact we're in a rising interest rate environment where basically the yield curve is going through a upheaval, which is going to cause banks to lose money. So this is not the best environment for banks, but it will be at some point, right? Once the curve flattens and everybody's realized their losses from their bond portfolio, it's going to be fine. Banks are going to make a lot of money, assuming they can get that that yield curve to a positive slope, they're going to start minting money. Right now, they're not, and they're not lending, and the banks are a mess. So I'm not a big fan of banks right now. But the point being is that if you look at the last 20 years as a paradigm, and more or less the last 40 years, as he said, the last 13, the last 40, we've been talking about the 80s, right? If we talk about it for the last few years, the last 40 years was a paradigm of interest rates dropping from 20%, depending on the bond you're in, down to zero. And now they've come back. We're in a new paradigm, and people are using the old paradigm rules for the new paradigm. That is not how you play the game. It's like playing chess, but using the rules for checkers. It's not how you play the game. If you want to lose, that's a great way to play the game, but that's not how you play the game. So the point being is you have to, if the rules change, the game changes, you have to change with it. You can't keep going, oh, old tech, old tech, old tech. You can't keep doing the same thing unless you want to lose a lot of money. So this is not to say that the future says, oh, it's going to be this paradigm and this is what's going to happen. We've been talking about this for the last 2 years. It's going to be messy. The 80s, the 70s, the early 80s, the late 70s were messy. It was marked by a massive amount of confusion in the market, which is what we're seeing now. People are confused about the direction. Why? Because the rules have changed and people don't know the rules have changed. They're still playing by the old rules. So until you get everybody playing by the same rules, you're going to get this messy middle where people are like, I don't know what to do. I don't know where I should invest here, there. Apple's done, I hate using individual stock names because I get in trouble, but with context, a company like Apple, which was, I don't know if it still is, was the largest by market cap of all companies. And it came out with earnings that people didn't like, and it sagged a little bit. But the point being is, like, when did that happen last? That people like sold off a tech stock because they had some bad earnings, or not bad earnings, it's more forecast. But the point being is, when has that happened last with like the Magnificent Seven? It's been a while. I have to go look it up and see when the last time that happened is. Point being is, things are changing, and people need to wake up to that. So if you're running a portfolio, or if you have a portfolio and it's like all tech all the time, you should probably change your tune a little bit. Or at worst case, let's take some profits off the table and let's stick it in some treasuries, and let's have a safety net. Because what happens if the stock market falls off this fall? Let's say we have a big crash in October, November, and we have, the market just goes through the floor, goes down 20, 40%, whatever. Let's say the Russian, the guy, head of the Wagner Group, I always pronounce his name wrong. Let's say he magically comes back to life, right? His plane crashed, magically came back to life. Oh, he appeared in Siberia again. Like, oh, he's over here, like Weekend at Bernie's. Let's say something like that happens and the market crashes, whatever. You have dry powder to work with. But if you don't have that, if you're all in equities, you're not going to have that dry powder to invest when things get cheaper. So I really want to point out that framework, because if you don't think about things in a three-dimensional, most of us think in 2 dimensions when we live in a 3-dimensional world. When it comes to investing, you don't play 2-dimensional chess. You have to play 3-dimensional chess, which is a much harder game. And you need to understand that. And if you don't understand that, you're going to be surprised by the markets. And we're going to talk next week about where we think the markets are going to go, because actually it's coming this Friday, because we're live right now. So as of this Friday, we're going to talk about where we think the market direction is going to go. But once people go back, once Labor Day hits and people go back to work on Wall Street, the market tends to move around a little bit differently, because right now everyone's on vacation. They're in their Hampton houses. They don't care where the market goes. They'll come back next Monday and they'll be like, all right, time to go to work. All you interns, get out of the trading desks. Like, we're going to go back and do some real work. So that's going to happen. You might see a shift going into September, October, but we're going to talk about that on Friday. So, Doug, you put up some other charts. Where should we go from here?
Sorry, had to get myself back on notice here. Yeah, so basically, I'm trying to find our system here. So basically, I did put a chart in there. I don't know if that's what you were looking for, Kirk. It was S&P 500 divided by M2. It's not really an overlay, but I'll let you talk about that a little bit more.
I'm not talking about this chart. I have no idea what it's saying.
Okay, good. Yeah,
we'll find another one for the show notes.
You were talking about the money versus its supply versus S&P 500, but yeah, we have had no time to really analyze that. We were looking at it really, really quickly. I think that one of the things that one of the charts that I put in here that I think what was interesting is just basically looking at, again, going back to the cash flow scenario. I put one in there: total consumer credit owned and securitized. And we can see here the percent change from a year ago. If we start like a July 2018, it was around 5%. And then, of course, we got into the recession, the COVID recession of 2020. And we saw total consumer debt owned and securitized dropped basically down to zero. Okay. From a change standpoint, not the debt didn't go away, but we were able to see that direct impact of the inflection of monetary supply. And I know people in the credit industry that said it was incredible period of time between 2020 and around 2021, 2022. When people got this money, the first thing they did is they started to pay down the debts that they had. And that allowed, of course, a reprieve of kind of the growing of debt. And it would have been a pretty consistent average change, at least going back to 2018, on the amount of consumer debt credit owned and securitized, going up right around 5% on average. Going down to zero for a couple of years is great. But as you can see here, we did see a pretty significant spike. And I think this is kind of a positive to a degree, that we're starting to see a trend line here, is that we did start to see this massively spike up going into the latter half of 2021, to where we hit 7.5 and then up to about a 10% change over the previous year. Now, if there was no change for a couple of years, a 10% change over the previous year may not be as much on a numerical basis as it may seem. We're starting to see that as we got into 2022, 2023, it's actually starting to see a decline a little bit again. The current observation, June 2023, is 5.7. So we're getting back down to that 5% average. That'll be very interesting, to watch, to see, because I know we've talked about, credit debt, being something that has significantly risen. But at the same time, if we're starting to see that securitized debt trend come back down, maybe there's a little bit of reprieve. Although, again, we have also seen, and again, could be a correlation, a rise in the amount of money that, that people have been made in the markets. Maybe they're using some of that again to try to pay down some debt. But overall, I think, the great chart you just put up here. In terms of U.S. credit card debt, again, there's securitized debt, there's unsecured debt, and this is a completely different category. You're talking, again, a steady rise from 2014 to 2020, going from about $600 billion to looks like about 875. Again, shows that there was a dip, a payoff of debt back, took it down almost, $150 billion or so. But here's what's concerning. Since mid 2021, the same time we started to see that spike in securitized debt. Again, a lot of that securitized debt spike might have been people going out, buying new cars, things like that, buying new homes, secured debt. But notice that the trend line, I know you took it down, much steeper since 2021, as the amount of credit card debt has gone to $1 trillion. Okay. So we went since 2014, we went from 600 million or 600 billion. What?
This is 1,000 in billions. I guess
1,000 in billions.
I guess that's a trillion.
Which would take us to a trillion.
I was quadrillion. Yes. The numbers are crazy. So
we're not there
what does
yet.
that even mean?
Quadrillion.
What is $1 trillion?
Quadrillion is the market cap of Apple eventually someday in the future, according to all Apple hopefuls and enthusiasts. But look at, if you just look at the angle of the debt since 2021 up to that, it has been a massive spike. And this is what is significantly concerning, because credit card debt, unlike mortgage and other installment type of amortized debt, is directly tied to the interest rate decisions. Directly meaning there's a little bit of variability, but as interest rates go up, these credit card companies pass those interest rates directly to the consumer in one way or another. And so what you're starting to see is a massive amount of debt that's unsecured being owned by Americans. And now you start to see on top of that a spike in the amount of interest that's going to happen, payments go on. Again, stuff we've talked about, deja vu. Another one that I put up there, and I'm just kind of bouncing back and forth. Yeah, so we're starting to see an increase in the 30-day credit card delinquency rate. It's actually not so bad yet. If you look at where we were in 2008 to 2009. We're not anywhere close to the problems that people were running into then. As a matter of fact, where we're at right now in 2023, just under 3%. It's kind of where we were, roughly between 2016 to 2020 and COVID before we paid it down. But again, watch the trend here. Since 2021, massive spike. Hopefully it stabilizes itself. But if we go back to the things I've talked about, $1 trillion in credit card debt out there, that means minimum payments are higher, utilities are higher, the car payment, the securitized debt that people might have had if they got into cars or home loans the last couple of years is higher. Student loans have been on reprieve, which also helped with paying down other debt. Those are going to kick back in. So again, the not to be bearishly concerned here, but if this is what happened between 2021 and 2023, when we didn't have all of these extra payments and somewhat before we saw, a lot of the impacts of inflation, we didn't have student loan payments. I mean, again, I'm not here to sell crystal balls. If I was really good at that, I'd be in a different career, but I'm not going to be surprised if we start to see this 30-day credit card delinquency rate surpass 3% and climb from there. So I think again, this is perfect examples. Whoops, dropping stuff around me. This is perfect examples of that vacuum that I'm talking about in terms of that's going to potentially be impacting people. The other things that we talk about that I think is important. There's another chart on here, kind of loosely related, but if you look at the federal government current transfer payments, or in other words, government social benefits to persons, no surprise here. I mean, again, just general increases in the amount of money that is provided by the government through social programs like Social Security. Well, guess what? We got to COVID and look what happened. Massive amount of money. I mean, let's face it, PPP, all of this M2 money supply, a lot of it was given out in terms of government social benefits in ways to people, carrying people on unemployment longer than the typical terms. So you can see that massive spike there that happened during the very condensed COVID period. Well, it's come back down. Now, have we lost it? No. As a matter of fact, look where that point is, Kirk. You can almost see that where it's at, kind of in the trend line of where that line would have gone had it not spiked in 2020. But we talked about this before. There's one thing that people are notoriously bad at. They're notoriously bad at change. And that means they're notoriously bad at change in a good way. So, for example, if you try to get people in 401ks to increase, or in retirement to increase their savings, very difficult to get them to increase their savings. If you make it a defined benefit and you make it something in which you encourage people to go out there and increase their savings, they won't, which is why they've seen a direct pattern in employers that have what you call instead of elective participation, it becomes automatic enrollment. Automatic enrollment means the employer is basically going to say, look, welcome to the company. Past this date, we're going to put you into the 401k plan unless you tell us otherwise. Whereas most 401k plans, you're going to be allowed to participate past a certain date, but now it's up to you. Well, the companies where they automatically enroll them, we have seen a significant difference in the amount of people that are contributing to retirement. Why? Because we don't change habits. So if the company enrolls you, some people will say, no, thank you. Most people just let it ride and then they get enrolled and then they're saving. And because it was automated, it was done for them and they won't change out. Well, those same kind of patterns are happening here, because when you start to see, a massive spike in the amount of money that people received, they start to get used to it. And we started to see a lot of people that began to create habits around money that was going to be there tomorrow. They don't plan for the impact of new student loan payments coming back in. They don't plan for the impact of higher utilities on top of that higher mortgage that they picked. Heck, they don't even plan for what the impact of that first mortgage payment's going to really feel like. Oh, and by the way, all of the other housing maintenance that people have to do. So when they buy the home, they think, my home is only going to cost me, oh yeah, okay, the new mortgage, okay, what would have been a $1,700 mortgage is now going to be a $2,800 mortgage. We can absorb that. But when you have maybe 1,000 or 1,500 square feet more, that's more air conditioning, that's more heating. You have, more maintenance problems. Again, especially if you were a transitioner from rent to purchase, all of a sudden, you accounted for maybe that $1,000 more that you paid in mortgage, or maybe you looked and said, hey, my rent's exactly the same price. This mortgage makes sense. It's the same thing. It isn't, because now you're responsible for all the things that landlord used to have to pay for. And then you looked at your cash flow and said, boy, we're doing all right. We're able to get by on this. Oh, you forgot that the college tuition payments the student loan payments were on pause and continual deferment. So these charts here, and I know there's more charts we can get into, but I want to obviously turn it back to you, Kirk. These are just really good things to watch that are showing, yes, we are starting to see that while we had a significant increase in the amount of money people had available, that's come back to earth. But what hasn't come back to earth is all of the debt obligations, the month-to-month increase in costs through utilities and just everyday expenses. And I joke about, this all the time, or, it's kind of a joke with a little bit of a tear, Kirk. But you think about our parents growing up, back in the day, they didn't have near the expenses that we had today. Yeah, it was expensive to call long distance, but your local phone line was pretty consistent. How many people are spending $200, $400 a month on cell phones? How many people are now spending $20, $30 a month on, security systems and security monitoring? Amazon makes it so easy to do a click one pay. If you really look at the sports programs the kids are part of, there's a lot more financial outflow burden that people are facing. And it was a tenuous balance that all of a sudden they got a few things paused, a windfall of cash, and they go, I can breathe again. That breathing is starting to get constricted. They just went from Minnesota to the mountains of Colorado. It's getting a little bit harder to inhale.
Well, that was a great segment, Doug. We're going to wrap it up here. Just want to mention a few different things before we do. The first is I found this chart and I just wanted to illustrate it. We've been talking about the mortgage rates for a while, and depending on where you are in the country, your mortgage rates are going to change. They're going to vary. But this is basically where 30-year mortgages are according to Investopedia. And if you look back in 21, early 22, mortgage rates were, 2.89 is what they claim. I actually saw some at 2.5, but whatever. Now it's up to 7.8. I've seen some 8 and change 30-year mortgages. So, if you think about, is this going to affect the housing market? It sure as hell is. It's definitely going to affect the housing market.
It is? How about yesterday?
Yeah, I mean, I'll just kind of, I'm going to just talk about my experience because I think it's important for people to keep in mind. And, if you own a home and you have no interest in moving, then none of this matters to you. But for anybody who's in transition or thinking about being in transition with their home, I wanted to clarify that, with their home, if you're thinking of moving, downsizing, upsizing, whatever, you can't do it. You can't, because if let's say I'm trying to, I live in Boston area, and like anything under $1 million is like you just can't find it. Let's just use that number because it's round numbers. So let's say you were trying to buy $1 million home back in 21. You could afford $1 million home. Let's just say like an 80-20, $800,000 mortgage. Let's say that's the claim. You could have afforded a 2.9% mortgage, but now that it's 8, you have to pay double. So you can afford a $500,000 home effectively. That's what you can afford in this new environment. Now, there are no $500,000 homes in Boston. There are, but not in the area that we're in. So, and what I mean is, I don't, when I say $1 million home, it's going to turn a lot of people off and be like, you're from Boston, like you're rich, whatever. Like, no, it's not the point. The point is relative to the area you live in, right? So if you live in Colorado or Texas or North Dakota, wherever you live, home prices can be cheaper. But in the area I'm in, like most homes are most homes are a lot more than $1 million. But point being is, like, let's say it's $1 million. Let's say that's the average for your area. This is an example. And now you can't afford that. Well, if homes are still listed $1 million and you can afford a $500,000 home, what do? Well, you can't move. You can't sell your house. Let's say you're going to sell your house and upgrade or sell your house and downgrade. Well, if I sell my house and downgrade, I have the same payments, assuming you have payments, right? If you have equity, it doesn't matter. But you sell your home and you got to buy something else. Well, you're buying something else, you still have to pay for it. So the problem is you can't move because you can't afford it. I have somebody living across the street. They just listed their home for like some ridiculous sum. I'm not even going to mention it because it's going to turn people off. Some ridiculous sum. Like, you're not going to get that. It's not worth that. You really, it doubled in the last 2 years? Heck no. So I think people are still living in this fantasy land that they can get these prices. And you know what? They might be able to get that price because there's always some person who's, let's just say, they have too much money and it doesn't matter. They're going to do whatever they're going to do, right? I live in the part of the country where people do that. They spend wealth like it doesn't matter. Now, for people like me and most people in this country, it does matter, right? I don't have endless supplies of money. I don't have money coming out of my ears. I actually have to make the numbers work like everyone else. So the problem is people aren't moving. They're like, oh, there's no supply. Yeah, because no one's moving and they can't afford to move. And that's not going to change, right? And we talked about this in the show for pretty much the last few months. But this chart's really important because if you're not accustomed to these rates, at some point people have to move. And at some point they're going to say, sorry, I can't afford that. I don't know when that is. And this is the big debate. Is it a supply problem or is it an affordability problem? I think it's an affordability problem. Most people think it's a supply problem. Well, maybe it's supply, but I don't think it's a normal metric because you don't have the same amount of houses on the market because people can't afford to move. So if you're renting and you want to buy, you can't afford to buy. It is so much cheaper to rent than it is to buy right now. Ridiculously different. Now, I talk about this in the show because I did some research like 10 years ago for a client of mine, and we were looking at should you rent or should you buy? We looked at the same home, which was listed for rent and buy, and it was like a 3-to-1 difference. The home, I think it was like 1.4 at the time, and it was 3-to-1. It would have cost 3 times as much to own than to buy. And so we just said, here's the metric. And I did more research and realized around 750,000 is the marker where the changeover happens. So over 750,000 in this area, it's more expensive to buy than to rent. Under that, it's more expensive to rent than to buy. So it's important to understand that. So right now, it's so far off the mark. I mean, if I'm right, I've talked about this in the show. I've been renting for the last 3 years since COVID. I sold my condo last year. I want to think I top ticked it, but we got a good price on it before rates went crazy. And, I think that's a win. But at some point, I have to get back in. But if I look at my rent compared to what it's going to cost me to own, I can't do it. I mean, makes no sense to even get into that water. It's so far different now than it was, and things are going to keep changing. And if we go into recession, that'll change again. But for right now, the real estate market, unless it starts to drop, the only thing that's going to cause people to be able to start to change their homes is lower rates. And you know where we stand on lower rates. So I think everyone's up for a nice surprise in the next 5 years if things don't change. I don't know what's going to happen. I don't recall an instance in our history where this has happened. I'm sure it has, but I'm not familiar with any. So it'll be really, really interesting because if you look back in the 70s, a lot of people bought with cash, and even though the rates were high, the home prices were lower. So I'm not sure it was affected then as it is now, but it's a big deal. So Doug, let's wrap it up here. Where can people find more about you?
Well, please. Right now it's August 28th. We're getting right into that season. I am a founder of Pro College Planners. I've been doing some seminars recently, and we're getting a lot of really, as we always do, talking to families about concerns, struggles, stress, financial worries about the cost of college. And as I've talked about already today, there's a lot of people with student debt. Parents have debt in their name. Students have debt in their name. The game has changed. It's gotten harder. And people want to know, how am I going to get through this? And it can have a significant impact on finances. So just go out there, start getting some information. We have a free tool. You can download our free report to look at 3 different schools to figure out what the true cost is going to be, your affordability. Costs nothing. Check us out at info@procollegeplanners.com. If you want that, that's an email. You can email to our team. or go to procollegeplanners.com, download our free checklist, and just start to get educated, because that kind of information can save you thousands of dollars and a lot of stress.
Great. Well, Doug, always appreciate you coming on the show. And for everyone listening, if you have kids that are in high school and you're looking to send them to college, which I think is probably most people, contact Doug. He's great for helping you save money in college. And I put this out there. We do a lot of we do a lot of marketing around this. But if you think about college, most advisors focus on saving for college. 529s, put your money in a Coverdell, like all this save, save, save. Great. But you're never going to save enough to pay for college. It's not going to happen. And if you're wealthy enough, you don't need to pay attention to this conversation anyway. So most people, most normal people, I'd say the 99.9% of the people can't afford to pay for college just out of their pocket. So it's not about saving, it's about spending less. And Doug is one of the few experts in this country that can help you save less for college. So highly suggest you contact Doug if you have kids in high school, anywhere from freshman to going into senior year. Doug's the guy that's going to help you save money for college. No guarantees, but if somebody can do it, Doug can do it. So Doug, thanks again for coming on the show.
Thank you,
That's
Kirk.
the show for this week. Thank you again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and the archive shows. Also, we're now on YouTube. Please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment to the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send an email and express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.